Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I was reading through the comments section. One of the comments was um, looking and trading back in 2018, natural gas broke a downtrend pattern. Why would this time, where we're kind of flirting with it, why is this time different? And why would it not come back down? And I'm going to kind of attack that question. I'm not saying it can't come back down. It very well could in the short term. But I think the entire commodity complex is going to be raised up over time. And what's going to cause that? That's the thesis of the entire channel. The thesis is expansion phase of real estate. That is where money comes into the system through the largest, we'll call it, gateway of inflation. If you don't have an expansion phase of real estate, you don't have a gateway for inflation to come into the system, at least the largest gate. The largest gate is an expansionary phase of real estate, which has new homes with new loans against it. The new loans is inflationary. That is the creation of money. And obviously there's other gateways. They can send checks to people's homes. They can do all sorts of stuff like that, or send checks to people's bank accounts, I guess is the technical term. But I'm going to show you the conditions and why they're a little bit different than 2018. So here we go. And again, one other thing I wanted to touch on is commodity prices are based off of two elements. One is the supply demand, and two is the inflation in the system, the money supply. So basically, it's the supply and demand of money, if you look at it from that perspective. Gold is what accounts for it, and gold accounts for the money supply during inflationary periods and increasing interest rate environments. Inflation comes from the real estate market. Interest rates come behind it, chasing inflation, because people sell bonds when they have a real negative rate, a real negative return on their investment. That's the nutshell. And you can look at some of my older videos. Maybe I dive a little bit deeper than that, but let's look at the charts here, and I can tell you and explain it. So this is natural gas, and the person was talking about 2018 in this circle here. We have a downtrend line. We broke the downtrend line. Like, oh yay, we broke out. We're gonna run. But we didn't run. We came back down, and now we're coming back up again, just like 2018. Why is this time different? Why should I care now versus 2018? If 2018 declined, well, why doesn't it just come right back down? And what I'm proposing is that I think you're going to be both right. You're probably going to get a decline down a little bit because we did have a hurricane, which is a short-term impact. Long-term, I think we're going to continue higher. And I'm going to go into why I think that. Here's another one, just a bigger picture view from 98, and this is the last commodity bull market. In 98, we had this move higher, which was gold and precious metals and all these other commodities went higher with it. The material pricing on natural gas, if you look, went higher the entire time all the way till 2008. Then we had the market crash. This increasing rate going up, and if you look at the lows, they kept going higher lows, higher lows, higher lows through this entire period because of an expansion phase in real estate. Gold was going higher. Everything was getting priced higher because of inflation and an increasing interest rate environment. This environment over here is in a recovery phase of real estate, and you don't have that inflationary push. You only have the supply and demand imbalances basically pushing the price up and down. But it didn't raise the entire pricing structure higher. What I'm telling you is what's coming ahead of us is a large revaluation of gold in relationship to the money supply in an expansionary phase of real estate. It's going to push this entire cost structure higher, the whole thing, based off of inflation. Now, this is the gold to natural gas ratio. This is the cost structure that is going to increase over time. The ratio may not change over time, but the entire structure will. So if gold goes up and natural gas remains relatively stable, you're going to price natural gas higher. Now, we're also breaking out of this wedge pattern to the downside. And is this going to maintain? I mean, obviously, we did a false break here and we did a false break there. We can't go much cheaper than this. I mean, this is a ridiculously cheap price right here. And that's the reason I bought so much in 2020. We're coming back, and I think this is going to continue to compress and stay relatively strong and probably compress all the way back down to 100 maybe. Somewhere down here at the peak of 2007, 2008, where we peaked out in natural gas. So I'm seeing a compression. Here's the oil to natural gas ratio, and I would say natural gas is getting a little bit of expensive to oil. A 1 to 20 ratio and above is cheap for natural gas. Below, I'd say 12 is pretty expensive. And we're kind of bouncing back and forth between those two ratios, just to let you know. So one thing we want to look at is also oil. What is oil going to do? Because if oil gets priced higher, if we have inflation, oil is going to account for that inflation. And then it's going to bring the whole oil, natural gas market up with it. And right now, if you look at oil price in dollars, I drew a bunch of trend lines here. We've got a channel coming up. We've got a more aggressive line up here. And what I'm proposing is we're going to break this downtrend line, which we just did. We broke it and we're back testing. We're resting a little bit. We're probably going to take off and we're probably going to hit this upper trend line. And if we go a couple years out, maybe it's at $200, $300, $400 a barrel. And then if we break this, and I don't know if we are, the next line's up over 1,000 a barrel on a logarithmic chart. Now you're thinking, how the heck could that happen? There's no way that oil could be priced at $300 or $400 a barrel. Well, I'm showing you it very well could. And the problem that most people can't get around is that it's going to be inflation. There's an inflation component. You could be at $200 oil and it's like being at $70 today. Think of it that way. 200 in 5 years is like $70 today. Then you've got the price squeeze, which will, the supply and demand squeeze, we'll call it, because money's going to rotate into commodities under this inflationary environment and when interest rates are going up. So you're going to have money flows going into oil and uranium and other commodities because that is where the returns are. That's where the momentum is. And that's where money's going to flow. So you're going to get financial demand for these products. That's going to push it that extra, from 200 to 400. I'm just making up these numbers, but that's the ratio compression against gold is money flows. The entire pricing of the assets higher is gold going higher. It's an accounting mechanism for money in the system. Now, here is the new privately owned housing unit starts. This is residential real estate. These are just new homes being built. The red line is the average. The red circles is when we should be buying commodities, when the commodity to stock ratio is flashing a buy for commodities. An expansionary phase of real estate is when you build more homes above the average. Expansion phase, it's a big one. Expansion phase, it's a big one. And we are underbuilt 3.8 million homes. That's why this line went all the way down here. We're underbuilt scenario. We've never been this underbuilt. And the demographic supports more homes. And that's why we're seeing real estate and home prices go up so much. We're not at a market top. We're at a market middle. And prices will slow down as we build more and more homes in an expansionary phase of real estate, but we haven't built the homes yet. There's no reason for home prices to go down. The active listing count will remain low, which I've gone over in another clip just recently, of the housing market conditions. And remember, house prices don't go straight up. There's seasonality to it as well. So we very well could go on a month-to-month basis down a little bit before moving on up because we're coming into seasonality weakness. Each year, the fall and winter is weak. So we're coming on up. We're building more homes, and this, I think, is going to go higher, causing an inflationary period. An inflationary period means higher interest rates. Higher interest rates means that money is going to flow from stocks and bonds into commodities. That money flow is going to push it far higher than what anybody believes. Why is that? These are the three circles. Undervalued, undervalued, undervalued. Overvalued for stocks or commodities, overvalued commodities up here, undervalued commodities down here. Stocks and bonds, the money flows from stocks into commodities, forcing this ratio higher over time. And then they call it these crisis, Gulf War, whatever. They just put names to it. This is going to rotate, and we've never been this cheap in a commodity to stock ratio ever, where we're at. And this is going to come back up, and money's going to flow from bonds and stocks back into commodities. And we're going to come way up. It's going to be a great rotation of money. And these green circles are the red circles on this one. And that's overlaid on the real estate expansion phase. That's when it revalues itself. The dollar is another important aspect, and we're coming back down to this trend line. I'm looking for a break of the dollar of this trend line lower. If we get this break, and remember, the entire world is printing money like heck, and this dollar is priced against a basket of other currencies. So even if this remains flat, we could get massive inflation with the dollar being stable. But usually what happens is, here's the last commodity bull market, is that the dollar decreases against other currencies because of an expansion phase of real estate. The real estate market crashed in 2008. We went into a recovery phase. Now we're coming back and we're going to an expansion phase. And I'm hoping that the dollar breaks this uptrend line to the downside. That's what my expectations are. And we get a decline in the dollar index against a basket of other currencies, signaling that this commodity bull market is game on. And that's when you're going to see the money flows really start to flow. Here's the 10-year interest rate. Back in 2008, we came up to a peak. This is when natural gas was taken off. We were coming up in interest rates from 2016 to 2018. We came on up and we came into an ascending wedge and broke to the downside. I believe they were buying bonds here. The Federal Reserve, they came out and said we need to buy bonds. It crashed, the coronavirus crash, and now we're coming back up, and we have symmetry here. Kind of the wing, here's our other wing, and I think we're going to move on higher. The market forces are going to try to push the 10-year higher unless someone acts upon it and buys the bonds to force rates lower. The yield, this is yields. Yields moving higher puts pressure on stocks and bonds to sell off and money to rotate into commodities and precious metals. I am suspecting this line to break down here, and we move on upward. Here's the commodity CRB index. We were in a downtrend line the entire time. 2018, we were still in the downtrend. We did not break the downtrend. Now, we broke the downtrend. Something changed. Commodity complex has money flows going into it. The big boys are putting money in here. We broke the downtrend. It's already there. It's showing us it's game on. Emerging markets, game on. All of the other ETFs, Australia, Canada, they're all game on and they're breaking their downtrends and moving up. In 2018, they didn't break their downtrends. So we've got confluence across the entire sector, across all over the place. And the last thing to drop is really the dollar to drop out of its uptrend line and the 10-year yield to move higher. And they may be in there buying it and trying to manipulate it. Gold's going to follow. Everything's going to follow when that interest rate starts to go up. Watch gold. If gold goes higher, the market's positioning itself for higher interest rates. And remember, the commercial banks know this before they actually do it because they're the ones controlling and manipulating everything. They're in there buying bonds. QE. Federal Reserve is the commercial banks. They own each other. The commercial banks own the Federal Reserve. And they know what they give signals. They tell each other what they're going to do before it happens. So they position. What we're looking for is the positioning. Positioning's happening in commodities. The ratios are starting to move. They're starting to move favorably. So I think that the entire complex is ready to move on higher. There's nothing saying that it can't go lower in the short term. There's nothing saying that. There's always risk, and the longer, bigger picture views that you take is the most reliable picture view. The shorter term that you take, the shorter duration and the time frame, there's always more risk, which means there's the risk of it falling back down. Could the stock market impact commodities? Very well could. I look at it as a buying opportunity because structurally, commodities have to go higher. They're under cost curves. They've been pushed as low as they can, and they've been basically suppressed or pushed to the cost curves. Maybe not suppressed. Maybe they're just down there. Maybe they're being held down. The reason they're being held down is that they're suppressing interest rates. That is suppressing or delaying the move of money. But they can't do it forever. What are they going to do? Just print money? That means the dollar is going to go down. If the dollar goes down, it spurs rotation of money into commodities and hard assets. They're backed into a corner. The Federal Reserve is backed into the corner. They're going to either sacrifice the dollar or the stock market and bonds. Because if they let interest rates go up to save the dollar, which they're going to have to, you're back at that argument. Dollar interest rates. Dollar drops, they have to raise interest rates to save the dollar and to slow down the inflation being created in the housing market. And more homes need to be built. You can't have your cake and eat it too. A lot of people say they can't afford interest rates going up. Well, they can't afford the dollar going away either. That's your decision. And they're gonna sacrifice the dollar for a good portion of the time, but you can only sacrifice it so much, I think. And then they're gonna say, okay, we gotta save it. This is where all our power and control comes from, is from the dollar. So we gotta slow this inflation down. We gotta raise rates some. Then that rotation of money comes into commodities and gold. Because you're gonna lose money in your bonds. You'll have a real negative return, real negative interest rate. And that's it right there. That's what rotates this whole thing. And all the commodity complex, there's two components: the supply demand and the inflation money aspect. Inflation is going to be accounted for in gold. And the ratio of oil to gold, if the oil to gold ratio is compressing favorable for oil, your gold price is also moving up with it. So the whole pricing mechanism gets priced higher when gold goes higher, and gets priced higher because that ratio of the supply-demand ratio compression is going to, if this is gold and this is oil, gold's going to go up as oil compresses against the ratio against gold. So oil is going to go up faster than gold. And then your oil energy companies and natural gas, they're going to get priced way up. You're going to go from the most undervalued state in 2020 to a most probably overvalued state at the end of this, because investments haven't been going into natural gas and oil. They've been getting starved. When you starve, and this is just not investments, you have natural declines and natural peaks coming too. You have a double whammy at the top here. You have a peak oil potential and a lack of investment in it. You could see a decline on the backside be absolutely massive. We could have, what would America look like if we could import zero oil? What would that look like? Because if everyone's going to fight for this stuff and the decline rates in a lot of these countries happen, then it's a fight for importing oil between all the oil importing countries. And it's probably the richest countries that are going to be fighting over what's left. So what's the price of oil? What's it worth? What's a barrel of oil worth? I would say it's more than what anyone thinks. The price of natural gas, the price of oil is far undervalued. When you're in a state where you've got plentiful oil, where it's everywhere, and you go to a state that's completely scarce of energy, of portable energy, what's energy cost? I mean, it's pretty rough to gather energy from sunlight and put it in a battery versus having this incredibly dense energy source, 1 gallon of gas, which can do so much work, versus humans doing the work or a horse doing the work. And that's where the value will be seen is, well, how valuable is a gallon of gas? $100 a gallon? I don't know. I mean, you go try to do the work of 1 gallon of gas as a human, and you'll say it's worth way more than $100. If you earn $100 an hour, some of these people make pretty good money, $100 an hour, $60 an hour. Go do work for 1 hour and then see how much a gallon of gas can do and how much more efficient a gallon of gas in mechanization is in relationship to human labor. Then you start thinking, well, a gallon of gas, $7 is cheap, $20 is cheap. Wait until it becomes incredibly scarce in the future and then figure out how much it's worth, the value of it. And that's where I'm contemplating. I mean, uranium too. we've been in this very plentiful resource world where the ore grades were incredibly high and we had tons of oil and gas. Wait until oil and gas becomes scarce, or at least more scarce, and wait until you see a deficit in it, which we're going to be coming into. Now, all these mining companies, there's earth between you and that mineral. And the only thing that can get between earth and the mineral is energy. Lots of energy use. And when you have declining ore grades, your energy use goes up exponentially when you hit certain points. So now, the way that I view things, a lot of things, and I'm not 100%, because I don't know when peak oil is going to happen, and I don't know when energy prices are going to go through the roof. It could be sooner than later. Physical metals in your hand would then be the most valuable because people are going to start nationalizing assets. They're going to start nationalizing oil fields. They're going to start nationalizing everything. So if you have physical metals that everybody wants and values in your hand, those are going to be incredibly valuable because no one's going to get their hands on them. So then the question is, what are the most valuable things and what's the toughest to get minerals out of the earth? If this scenario plays out, it might not. That's why I have mining companies and royalty companies and why I also have physical metals. I'm splitting my bet. I'm splitting my physical bets and saying, this could happen. I'll just buy a bunch of it because it's so valuable to humans. And then I buy the mining companies because we are at incredibly low valuations already. And I think this is all going to rotate quite rapidly given the market conditions that I've described in real estate. So that's what I've got. I'm a huge bull in commodities because of the market conditions and where I think money can rotate from stocks and bonds into commodities eventually. I don't know the timing of it. But when interest rates start to go up, I think we're getting close to that time. If you guys like that, if you guys like this content, give me a thumbs up. Subscribe to the channel if you like the content. And thanks for listening. This is Finding Value.